Welcome back. You're still tuned into Trading Hour. It's time to discuss some market fundamentals. Sahil Kapoor from DSP Mutual Fund is joining in now. And in their December report, there is an interesting section which talks about why India outperforms over the longer term. Sahil, good morning. Thank you so much for joining in. I just wanted to understand that because so far in last couple of trading sessions, we talk about this big retail inflow. And maybe that is what is keeping the markets afloat despite FII outflows. What, according to you, are some of the major reasons that you attribute to this long-term outperformance that we've seen?
I think flows and probably GDP growth are two of the most simplistic reasons that we attribute to India's outperformance. But institutional flows in totality have been very consistent. They haven't been up or down if you add up all institutions. But I think the broader reason why India has done well has got to do with the quality of businesses we have. So we looked at data across the world. And we looked at, let's say, United States, India, emerging markets, China, etc. When you look at, let's say, US, 39% of companies have delivered an ROE of 20% or more over the last 20 years. India stands at the second place with nearly 1/3 of all companies in India delivering a consistent ROE of 20% or more. Now, this is very rare when you look at the emerging market basket as a whole and you adjust for cost of capital because most countries have a different cost of capital. India again stands at the second spot, just behind United States. If you remove, let's say, the top FANG companies of United States, India will actually get to spot number 1. So first is, even adjusted for cost of capital, Indian businesses have delivered very high shareholder value when you measure it by ROE. And when you look at, let's say, emerging market as a pack, it has actually detracted shareholder value. It has delivered negative value to shareholders. So this is one of the chief reasons why India has done well. Second, of course, is the consistency of how this has happened. So when you look at the NSE 500 universe, there are about 50 companies, 49 to be precise, which have grown their book value, which could be one reason, not the intrinsic value, every single year over the last 20 years. And there are, for example, there are only 2 or 3 banks globally which have reported a rise in book value every single year over the last 30 years, and 2 of them are Indian banks. So these are very, very rare numbers. They are not available across the world. And third, possibly one of the reasons when you look at global leaders in the top 14 sectors we looked at, for example, banking, aerospace, oil and gas, etc. We looked at 14 sectors. In 10 of these 14 sectors, Indian business leaders have a higher return on equity versus the global leader. So, and second, if you look at the earnings per share growth over the last 20 years, 12 out of these 14 sectors, India is ahead in terms of earnings per share growth. So I think these are some of the very, very important nuances which are more bottom up, which allows investors to identify good companies and probably ride them over time. Other parameters, for example, a stable GDP growth, of course, that is one of the factors, but it is, I think, only an enabler. When you look at it from a longer term perspective, there are many countries which have, for example, China, done much better in terms of real GDP growth rate, but the businesses there have fared much worse. And there is another country, for example, Brazil, where GDP growth has been dismal at about 2.5%, but their dollar returns have been much higher than India. So I think all these narratives of flows or probably of growth can be easily falsifiable if you just look at a few data points. So at the core of outperformance, I think, stands the quality of Indian businesses.
So that positions us very well for long-term returns in equity markets. And historically, equity has always done better than debt. But there have always been cycles, even in this uptrend, where debt has done better than equity. So if just someone looks at it, there is a 1-year cycle, 2-year cycle. So for the next year, 2025, what's the outlook on equities per se? Just again, 1-year view on equity versus the other asset classes like debt, gold. And while continuing your SIP, should also one be looking at, these other asset classes which could, just in the near term, give you better returns?
No. So 1-year outlook most likely is going to be random. I have no clue what will happen in the next 1 year. But one thing is very clear, Indian markets are trading at a, very, very expensive valuation in some pockets. There are pockets where there is probably attractiveness, but as a whole, we are in, let's say, in a rich zone in terms of valuation. And the same report talks about where we are in that, whole bucket. So when you look at these numbers in totality, and let's say you look at a number called, let's say, Nifty's price to earnings ratio versus the peak EPS, which is the highest earnings that we achieved. currently we stand at a place which is close to the peak of, let's say, 2008 or 2017 December cycle. So our valuations are not very attractive on the whole, which means that probably the recent returns may not get replicated in the future, in the near future. And to your second point, should we continue our SIP? I think if we can continue our SIPs for, let's say, infinite period or perpetuity, there is no reason to listen to any of these views, including mine. You are accepting, longer term average returns, which probably should be better. As I said, quality of businesses is good. And most businesses, some of them, if they come into a portfolio, will deliver returns which are higher than bond markets, right? So for any SIP investors, the idea is to continue their SIP forever, irrespective of where the market is or where the valuations are.
Get that point. Sahil, then let's just talk about the different market cap universes, right? We've been speaking about how, and your report suggests that large cap stocks are the smallest share of market capitalization. Then how does one go about investing in, say, small caps versus large caps currently? You think large cap outperformance, which was expected to happen in 2024, is a theme that could work in 2025?
It could, of course. I think when you look at the numbers and if you are a believer in mean reversion, then possibly there is a place and idea to put money in, let's say, large cap in terms of relative allocation. From a small and mid cap perspective, I think we'll have to be extremely focused on quality because there are pockets within this small and mid cap space which have become expensive. And historically, we've seen that there are long periods where they don't deliver returns. For example, a period like 2008 to and then 2016, there were hardly any returns in small and mid-cap stocks because you had a stellar rally before that. So usually, high recent returns are followed by low returns eventually. And currently, we have a mix of high recent returns and also high valuations. So I will probably adopt a staggered investing approach in small and mid-caps. In the last question, we asked about SIP. If you are a SIP investors, you should, continue just doing that. But if you're putting a new absolute rupee into the market today and probably looking at equity as an asset class, then I will lean towards allocating more to large caps. This does not mean that large caps on an absolute basis are cheaper, right? They are also trading at, as I said earlier, at rich valuations. They are not cheap, but on a relative basis, I think they will hit the value zone much earlier than mid and small cap. If a correction occurs. And as you said, currently, let's say the top 10 stocks compared to the total market capitalization have a share of only 20% in terms of overall market cap, which is, I think, an all-time low. If you go back to data 30, 40 years also, you will not find this data occurring anytime in the past. And there are many reasons why this has happened. One of the reasons is that small and mid caps have done extremely well. And second reason is there has been a huge amount of paper which have been raised, equity issuances, and the average listing, let's say price to earnings multiple for a large number of these issues is more than 70 times. So which has taken a huge market cap to this universe and made the top 10 or even the top 50 stocks, much more cheaper on a relative basis. So I think that is the reason why you should look at large caps.
Thank you, Sahil, for joining in and giving us all those data points. Great conversation. Get into a break. On the other side, we'll tell you the key expectations from the RBI monetary policy later tomorrow.